$84.33. That's where silver spiked to in early March 2026. And if you think that number is just a routine blip on a chart, you are about to find out why you couldn't be more wrong. Because right now, as you're watching this, traders across the globe are nursing some of the most brutal margin calls they've ever seen. Accounts that looked healthy at the open of the week are being wiped out by nightfall. Stop-loss orders are cascading into thin air. And the institutions sitting at the top of this market? They knew. They planned for exactly this. By the end of this video, you're going to understand not just what happened at $84.33, but why it had to happen, who benefited from it, and, most critically, what it signals about where silver is headed next. Stay with me, because this is one of those moments where the noise gets deafening right before everything changes. Let me start by painting the picture of what this market actually looks like right now, because the headline number doesn't tell you the full story. Silver hit $121 per ounce on January 29, 2026. That's not a typo, $121. And then, in one of the most violent reversals in modern commodity history, it collapsed to $63.85 by February 6th, a crash of nearly 47% in just 8 days. 8 days. Then it bounced, clawing back through the 70s, the 80s, nearly touching $96 at the start of March before another violent pullback slapped traders back down. And now here we are, with silver fighting around that $84 level, and a market that is absolutely on edge. This isn't normal volatility. This is a market in structural transformation, and if you don't understand what's driving it underneath the surface, you're flying blind. According to data from the Silver Institute, and I want to be clear throughout this video that I'm citing documented sources you can verify yourself, 2026 is the 6th consecutive year of a structural supply deficit in the global silver market. 6 years in a row. The Silver Institute confirmed this in their most recent annual outlook, noting that physical investment demand is forecast to rise 20% this year to a 3-year high of 227 million ounces. Total global supply, including mining and recycling, is projected to reach just over 1.05 billion ounces. And demand? Demand keeps eating into that number every single year. In 2025 alone, the deficit was documented at 230 million ounces. 230 million ounces short. To put that in perspective, that is the entire annual silver output of Mexico, the world's largest silver producer, just evaporated into a demand hole in a single year. Now here's where it gets interesting, and I want you to pay very close attention to this part, because this is where most people's understanding of silver completely breaks down. There are two silver markets operating simultaneously right now, and they are telling completely different stories. There's the paper market, the futures contracts traded on the COMEX in New York and the LBMA in London, and then there's the physical market, where actual bars of real metal change hands. For decades, the paper market has controlled the price. The notional ratio of paper silver to physical silver sitting in vaults has at times reached as high as 356 to 1. 356 paper ounces of silver traded for every single physical ounce that actually existed. That's not a market. That's a casino where most of the chips are made of cardboard. Quick note for those of you who aren't subscribed yet. My analytics show that roughly 3 out of every 4 people watching right now haven't hit that subscribe button. If this kind of deep, evidence-based analysis is cutting through the noise for you, I'd ask you to subscribe right now. That's how I know who my committed community is. It helps me keep doing this research, and it genuinely helps the algorithm get this information in front of more people who need it. Okay, back to the casino. So what's cracking this paper versus physical gap wide open right now? 3 things are converging simultaneously, and each one by itself would be significant. Together, they're historic. First, China. On January 1st, 2026, Beijing implemented a new export licensing framework for silver, requiring government approval from the Ministry of Commerce for any silver to leave the country. This is not a quota reduction. It's a qualification-based system that effectively sidelines small and medium-sized exporters entirely. The result? China, which controls between 60 and 70% of global silver refining capacity, has essentially pulled the plug on a massive portion of global refined silver supply. Analysts at multiple institutions are projecting annual deficits exceeding 5,000 metric tons if Chinese exports fall by even 50%. This is what one analyst at FX Street described perfectly. Beijing isn't restricting exports because officials worry about speculation. China needs the silver, and the government has figured out something Washington hasn't. The clean energy transition runs on metals, and whoever controls the metals controls the transition. Second, the physical drain at COMEX. This is documented. You can pull up COMEX registered inventory reports yourself. COMEX registered inventories, meaning silver that has actually been warranted and is immediately available for delivery against futures contracts, have fallen by over 70% since 2020. Over 70%. JP Morgan's registered pile has been cut nearly in half in recent months alone. And here's the detail that should make every trader watching this sit up straight. In just 7 days between early and mid-January 2026, 33.45 million ounces were physically withdrawn for delivery from COMEX. That is 26% of COMEX's registered inventory, gone in a single week. And according to reports coming in from this past week, we are now seeing trading freezes on COMEX because sell orders are briefly overpowering available physical inventory. Trading. Freezes. On the world's largest commodity exchange, because there isn't enough real silver to honor the paper promises that were made. And third, the delivery stress crisis that's been building in the March 2026 futures cycle. This is what triggered the $84.33 spike, and this is what's been slamming traders who weren't positioned correctly. Multiple sources this week, including FX leaders and financial content, reported that the COMEX is facing unprecedented delivery stress in the March cycle. There are even rumors, and these are documented in the financial press, of what's being called cash for delivery incentives, where the exchange is reportedly offering cash bonuses to traders who agree to close their positions rather than demand physical metal. Think about that. The exchange is essentially paying people to walk away from the physical metal they're legally entitled to because the metal isn't there. If that doesn't tell you everything you need to know about the state of the paper market, I don't know what will. Now let me give you some historical context, because this pattern has played out before, not in silver specifically, but in other commodities where a structural disconnect between paper promises and physical reality finally snapped under pressure. The most recent and relevant example was the London Metal Exchange nickel crisis in March 2022. The LME nickel situation unfolded when short positions massively exceeded available physical supply. Prices spiked over 250% in a matter of hours. Not days, hours, before the exchange took the extraordinary step of canceling trades, suspending the entire market, and modifying margin requirements to prevent complete systemic breakdown. Traders who were short got bailed out. Traders who were long got their profits erased by exchange intervention. The LME essentially rewrote the rules of the game mid-hand because the alternative was a collapse of the exchange itself. The parallels to today's silver market are not subtle. When paper promises massively outweigh physical reality, the resolution is never orderly. It never is. And that brings me to what actually happened this week with the $84.33 price level, because this wasn't a random number. This was a battlefield. Let me explain. After silver's January peak at $121 and the catastrophic crash to $63.85, the metal began recovering. It ground through the 70s, reclaimed 80, and then hit a critical technical zone, the $83.60 to $84 resistance shelf. According to COMEX futures analysis on TradingView, this level represented the price at which silver had previously traded before the breakdown, a price memory burned into the algorithms and the positioning of every significant trader in this market. This was the test. If silver could break convincingly above $84, the path opened toward $88. Then $91, then back toward $96. If it failed, the downside target was $80 to $81 on the immediate retest. And when silver spiked through $84.33, every trader who had placed stop-loss orders just above that level got hit simultaneously. The stops triggered, more buying cascaded in, and the price moved violently, exactly as institutional players who understood the positioning data would have predicted. Here's what makes this particular spike so significant. COMEX silver futures are showing something called backwardation. Futures prices are trading below spot prices. That's backwards. Normally, futures trade above spot because you're paying for time, storage, and financing costs. When the opposite is true, when spot silver costs more than silver promised for future delivery, the market is sending a distress signal. It means buyers are willing to pay a premium to have real physical silver right now, today, in their hands, rather than a promise of silver at a later date. That is not the behavior of a healthy market. That is the behavior of a market where physical scarcity is overriding financial theory. Now let's talk about who knew what was coming and when. According to the Commitment of Traders report dated February 17, 2026, the managed money category, which covers hedge funds and commodity trading advisors, held a net long position of just 5,472 contracts. Now compare that to the period when silver was running toward $121. During that rally, managed money was positioned at multiples of that level. What does it mean when the big speculative funds are sitting on the sidelines with minimal long exposure, right as the physical market is screaming about delivery stress and inventory depletion? It means the smart money is waiting. They want to see a confirmed base, a clear breakout above $92 before they commit serious capital. And once they do commit, with that much firepower sitting on the sidelines, the move that follows will make the January spike look like a warm-up. There's also something deeply unsettling in the CME Group's behavior that I need you to understand, because this is documented history. On January 7, 2026, the CME Group announced it was raising silver maintenance margins by 47%, from roughly $22,000 to $32,500 per contract, a 47% increase overnight. The official explanation was that this was a standard response to volatility. But ask yourself, if you're a trader who was winning, who was correctly positioned long on silver, and overnight the cost of holding your position jumps by $10,500 per contract, what do? You liquidate. You have to. You either come up with more cash immediately or you close your position. And who benefits from thousands of long traders being forcibly liquidated? The short side of those trades. The same short sellers who, according to court cases and regulatory settlements going back years, have repeatedly used structural advantages in the futures market to extract money from retail and smaller institutional participants. The CME margin hike hit particularly hard in India. In Rajkot alone, 44 silver trading firms officially declared insolvency, with combined liabilities close to $425 million. These were firms that held paper positions, not physical bars. When the exchange moved the margin goalposts, they were wiped out in hours. This isn't abstract. These are real businesses, real people, real economic damage, caused by a rule change implemented at precisely the moment it would cause maximum harm to leveraged long positions. Now let me show you the really alarming part of this picture, because we've been talking about the financial architecture, but the deeper story here is industrial reality. And this is where the $84.33 spike starts to look not like a peak, but like a pit stop. The International Energy Agency published analysis showing that by 2030, the solar and electric vehicle sectors alone will consume half of global silver output. Half. And unlike gold, where demand is primarily monetary and can be elastic, where you can always find a reason to substitute or delay purchases, silver's industrial demand is almost completely inelastic. Factories need silver to keep assembly lines running. Solar panel manufacturers need silver paste to connect photovoltaic cells. Semiconductor fabs need silver bonding processes for advanced chips. None of these users can simply decide to use less silver because the price is inconvenient. They either have silver or they stop producing. The IEA's numbers also reveal something that the mainstream financial press isn't connecting clearly enough. At current consumption rates, some industrial regions have barely 30 to 45 days of accessible silver reserves. 30 to 45 days. That's not a supply chain cushion. That's a supply chain cliff. We are one major geopolitical event, one additional export restriction, one unexpected surge in solar installation demand away from industrial users having to pay whatever price the market requires. And we've already seen what happens when they start competing for limited supply. Silver tripled in rupee terms in India over 2025 as the country scrambled to become the world's largest importer of refined silver, with imports estimated at $9.2 billion, a 44% increase year over year, even as prices were skyrocketing. Bank of America's head of metals research, Michael Widmer, has maintained a forecast of $135 to $309 per ounce for silver in 2026. Now, I'm not here to tell you $309 is happening. Nobody knows that. What I'm telling you is that when a major institutional research desk at one of the world's largest banks publishes a price target that sounds insane, it's worth asking why they arrived there. Their methodology is based on historical gold to silver ratio compression. Historically, in real monetary stress cycles, the ratio of gold to silver prices compresses dramatically. Right now, with gold above $5,400 per ounce and silver around $84, the ratio is sitting at approximately 64 to 1. But in previous monetary stress periods, In the late 1970s, in 1980, that ratio compressed toward 15 to 1. Deutsche Bank has also flagged the possibility of silver reaching $100 by year-end. J.P. Morgan published research expecting an average of $81 for 2026, while specifically noting the metal can significantly overshoot during periods of strong institutional inflows. Citi maintained a bullish view for the 6 to 36-month timeframe. These aren't fringe voices. These are the biggest financial institutions on the planet. Here's what I want you to think about when you look at the price action around $84.33. The entire story of silver right now can be summarized as a race between two realities. Reality number one, the paper market, where you can sell silver you don't actually own, where margin requirements can be changed overnight, where settlement can be done in cash instead of metal, where algorithmic stop hunting can move the price 10% in a session. This is the reality that produces volatility. Reality number two, the physical market, where the actual metal either exists or it doesn't, where 6 consecutive years of supply deficits have carved a 230 million ounce hole in global inventories, where China just locked up 60 to 70% of global refining capacity, and where Samsung, yes, the electronics giant, recently locked up 100% of the output of a Canadian silver mine for 2 years, specifically so they wouldn't have to compete in the open market. When Samsung is securing silver mine output through private contracts rather than buying on an exchange, that tells you everything about where physical supply is actually going. COMEX registered inventory data, which you can verify at the CME Group's website, shows that the silver available for immediate delivery has plummeted by over 70% since 2020. The Silver Institute, which is the silver industry's primary research organization, confirmed in their 2026 outlook that we are now in the 6th consecutive year of a structural deficit. Wheaton Precious Metals just secured a $4.3 billion silver streaming deal with BHP Group for the Antamina mine, which will boost their 2026 production by 11%, a sign that the largest streaming companies in the world are placing multi-billion-dollar bets on sustained high prices and tight supply. These aren't small moves. These are structural bets being placed by institutional players who have access to information the retail market simply doesn't see. So what does this mean for you specifically? I want to get very practical here, because the analytical picture is one thing, but how you position relative to this information is what actually matters. And let me be clear, nothing I say in this video is financial advice. You need to make decisions based on your own situation, your own risk tolerance, and ideally with a qualified financial professional. That said, here's what I see as the 5 key practical implications of everything we've discussed. First, if you're a futures trader and you're playing silver right now, understand that the $80 to $84 range is being described by every major technical analyst as the key battle zone. A convincing close above $84 opens the path toward $88 to $91. A failure and close below $80 exposes the $76 level as the next test. The volatility isn't going away. The COMEX delivery stress creates the potential for violent intraday moves in either direction. Risk management has to be your primary concern. The margin hike from the CME last January wiped out 44 trading firms in Rajkot overnight. Don't be so leveraged that a rule change ends you. Second, if you hold physical silver, the backwardation in futures is speaking directly to you. The market is telling you that what you're holding is worth more than the paper price suggests, because the paper promises are losing credibility. The divergence between spot prices and futures, between paper and physical, tends to resolve in one direction over time. It resolves toward physical reality. History says that's where the price ultimately lands. Third, pay close attention to the COT report over the next several weeks. Managed money is at historically low net long positions, just 5,472 contracts as of mid-February. That's the spring being coiled. When hedge funds and commodity trading advisors make the decision to re-enter with serious capital, and the trigger will likely be a confirmed breakout above $92, the price movement will be fast and it will be significant. Watch those weekly COT reports. Fourth, understand the supply timeline. The Silver Institute has confirmed that mine supply increases by only 1% in 2026. The reason the supply can't respond faster is geology. New mining projects require 8 to 12 years to develop. The ore grades at existing mines are declining. As one analyst put it perfectly, the supply cavalry isn't coming. It's geologically stuck in traffic. There is no scenario where the physical supply problem resolves quickly. Any resolution happens through demand destruction at very high prices, and most industrial demand for silver won't see meaningful destruction until prices reach somewhere above $134 per ounce, according to analyst estimates. That means the fundamental pressure remains. Fifth, watch China. The export licensing framework is in place through 2027, according to the Chinese Ministry of Commerce. The rules establish a system of graduated controls, which means Beijing has the ability to tighten further without any formal announcement, simply by approving fewer licenses. Every geopolitical development between China and the West is now a silver market event. Any escalation in trade tensions, any expansion of strategic material restrictions, any disruption to the authorized exporter list, these become immediate supply shocks in an already deficit market. Let me bring this full circle, because I want to return to that number, $84.33. When I look at the complete picture, the COMEX delivery stress, the 70% collapse in registered inventories, China locking up 60 to 70% of global refining capacity, 6 consecutive years of structural deficits, managed money sitting at historically low long positions waiting for a trigger, Bank of America targeting $135 to $309, Deutsche Bank targeting $100 by year end, Samsung bypassing exchanges to directly lock up mine output. When I look at all of that simultaneously, $84.33 doesn't look like a crisis price. It looks like the price that's making traders panic because they don't understand what's actually happening underneath it. The people who get hurt in markets like this are always the ones who focus on the short-term price movement without understanding the structural shift underneath. They watched silver at $63.85 and thought it was crashing. They watched it at $84 and thought it was too volatile to touch. Meanwhile, the institutions that understand what's actually happening, the ones filing those COT positions, the ones signing $4.3 billion streaming deals, the ones locking up entire mine outputs, they're doing something different. They're converting paper exposure to allocated physical. They're securing long-term supply through direct deals with miners. They're waiting for the retail crowd to exhaust itself on the volatility so they can step in with size above $92. Here's the historical truth that this market keeps illustrating over and over again. In every major commodity cycle, in every transition from paper dominance to physical reality, the warning signs appear months before the resolution. The inventory data changes, the backwardation emerges, the big players start securing direct supply. The exchange starts adjusting rules to try to manage the pressure. And most people miss it because they're watching the price on a screen instead of watching what's actually happening to the physical metal. The signs were there in January when 33.45 million ounces were pulled for delivery in a single week. They're there now in the trading freezes being reported on COMEX. They're there in Samsung's mine offtake agreement. They're there in the Silver Institute's 6th consecutive deficit confirmation. The question isn't whether silver's structural story is real. The documented data is overwhelming. The question is whether you'll understand what's happening while it's happening, or whether you'll recognize it only in hindsight, when the move has already been made. Drop a comment below and tell me, are you positioned in physical silver, paper silver, or neither right now? And what's the one thing from this analysis that you're going to pay attention to going forward? I read every single comment, and your perspective genuinely shapes what I focus on next. If this video gave you something real, something that cuts through the noise, hit subscribe. Share this with one person you think needs to understand what's happening in this market. And I'll see you in the next one, where we're going to dig into exactly what the COT data is telling us about the timing of the next major institutional move in silver. Don't miss it.